The aggressive investor is someone who is not content with just steady returns. They start with a solid foundation, usually focusing on defensive strategies like high-grade bonds and stable stocks. But their true goal is higher returns, and they know this requires taking on more risk. Once they've built a secure base, they begin to diversify into more volatile and higher-risk assets for the potential of much greater rewards. As an aggressive investor, the initial step is to move beyond traditional safe assets like high-grade bonds and stocks. These assets are seen as secure investments, but they come with low returns. For instance, high-grade corporate bonds or blue-chip stocks are stable, but they're unlikely to deliver the kind of returns an aggressive investor seeks. Instead, they look for opportunities that promise greater rewards, albeit with more risk. One of the key strategies for the aggressive investor is buying inferior bonds and stocks, but only when they're priced at significant discounts. For example, an investor might purchase bonds at 30% below their par value, or stocks that have fallen significantly in value but still show potential for recovery. The key here is timing and market conditions. If the market turns around, these discounted assets could provide substantial returns. Second-grade bonds, which have lower credit ratings, and preferred stocks offering fixed dividends, can also offer higher returns. These bonds typically carry a greater risk because the issuer may have a lower chance of paying back their debt. However, when these assets are deeply discounted, sometimes 50% off their face value, they become more attractive to the aggressive investor who's willing to take on additional risk for the potential of high rewards. A fundamental concept for the aggressive investor is understanding the relationship between risk and return. The more risk you take on, the higher the potential return, but also the higher the chance of loss. It's crucial to be prepared for potential losses, but to make decisions based on research, market trends, and a calculated approach to risk. An aggressive investor excels at identifying undervalued opportunities. This means recognizing assets that are temporarily undervalued in the market, whether it's stocks, bonds, or even entire industries. This requires a deep understanding of market trends and an ability to analyze financial reports, industry shifts, and global events. By purchasing undervalued assets and waiting for market conditions to improve, the aggressive investor stands to gain significant returns. Timing is critical for the aggressive investor. While they're prepared to take on high-risk investments, they're also patient. They wait for the right moment to enter the market, often during downturns when prices are lower but the potential for recovery is high. It's about knowing when to be patient and when to act. In conclusion, the aggressive investor seeks to capitalize on opportunities that others might overlook. Whether it's second-grade bonds, preferred stocks, or other high-risk assets, their strategy is about buying undervalued assets at significant discounts and holding them until the market recovers. It's a strategy built on high-risk, high-reward decisions, where patience, research, and calculated risk-taking are key.